Hey, what's up? It's episode 117, Payne Points of Wealth, and we got a very special edition today. We have one of our favorite Wall Street strategists on our show, Ed Yardeni, who has a research firm that we follow very, very closely. Ed's going to be on the show today, and we're going to talk about the economy. We're going to talk about the markets, and we're going to talk about Ed's viewpoint. When we share very closely on a lot of issues, probably one of the other few optimists out there, I would say, on Wall Street. There's not many of them. But Ed, you're one of the best, and you're kind of like our invisible wingman. I steal your stats all the time for TV, so thank you. I should probably give you some royalties. But having said that, great to have you on the show, and we're honored to just chat with you about the economy. And you pretty much versus everybody else has been pretty optimistic the whole way through here, as every strategist on Wall Street seems to call for a recession, but you have not.
Well, I've been in the soft landing camp. What I've really been in is in the rolling recession camp. I've actually been arguing that we've been in a recession since the beginning of last year. We've been having one. If you're in the housing industry, single family housing has been in a terrible recession. Retailers got stuck with a lot of inventory at the end of last year, and they had to discount it because consumers pivoted away from buying goods to buying services. Now I think we can anticipate that there will be a recession in the commercial real estate market. Uh, but all in all, it just hasn't added up to an economy-wide recession. And why that's important is because that's relevant to earnings, and earnings are relevant to the stock market. And as we've seen, the market always seems to be able to find something to invest in, and it always seems to be a contrary uh, view by the market. So we've had a real nice rebound here in what I call the mega cap eight. Those stocks have done very well, but it hasn't just been those stocks. We've seen a fairly, there've been lots of other areas where the market's done reasonably well.
Yeah, we saw a nice rebound, and international's been outperforming so far this year. And I don't think a lot of people recognize that a lot of the European bourses are near their all-time highs. So
Yeah.
people seem surprised at that. But Ed, I got a chuckle the other day out of a comment you made that people accuse you of being a permabull, and you took that as the highest form of flattery, and I appreciate that.
Well, look, I think if you look at a chart of the S&P 500 or the Dow and go all the way back, to the beginning of the 1920s, just so we make sure we captured the Great Depression. The reality is the market goes up on average most of the time. I think what happens to investors is they do get fixated on the historical negatives, and certainly the Great Depression and the Great Crash is, we didn't live it, but it seems to be something that we're all kind of fearful of. Then again, we did just have not too long ago the great financial crisis, and the market took a dive back then, and it stayed down for quite a while. But it did recover, and we've seen that the problem with trying to get out at the top is you got to make sure that you get in at the bottom. Otherwise, you're probably going to wind up getting back in where you had been many years later. And meanwhile, missed on the compounding of dividends.
Well, Ed, we're wealth managers. We do financial planning. We manage a lot of money for high net worth individuals, and what I found, if you do time this thing correctly, it's impossible to be successful, because if you got out at 14,000, back in '08, trying to get people back in when when the market's on sale is near impossible.
Yeah.
Because the fear level's so high
So, yeah.
when the opportunities are greatest. So I agree with that. You made a comment about commercial real estate. I'm getting a lot of concerns from clients that this is going to be the next, big event that's going to take down the economy, because banks are going to be taking back all this commercial real estate and multifamily housing that's been built lately.
Well, I think it's important to recognize that the Fed and the FDIC responded very, very quickly to the banking crisis. SVB, the Silicon Valley Bank, basically imploded on March 10th. It was a Friday, and then on March 12th, late in the day, it was a Sunday. Both regulators came in and did what they're supposed to do. They're supposed to be the lenders of last resort and the restructuring regulators of last resort, and that's exactly what they did very, very quickly. And the Fed came in with a new facility, liquidity facility. They're very good at coming up with these things. They've had a lot of experience coming up with these facilities overnight. And that's what they did with the banking sector. They gave them a facility where they could borrow for a 1 year period, and they could put collateral up as their bonds at par, not at market value, which has been an issue here. Uh, it was a major issue for Silicon Valley Bank. So I think that, the Fed's not in a position to insure deposits. The FDIC does that, but even the FDIC can't just willy-nilly raise the amount of money that is insured. Congress has to be involved in that. But what the Fed did is it didn't insure, but it guaranteed that the banks would have plenty of liquidity in the event that they had a deposit run. And of course, that very fact of doing that kind of calms everybody down, and you get less of a run. But look, you know, uh, Friday afternoons, 4 o'clock and later, I think we all are used to kind of decompressing and looking forward to the weekend. Now at 4 o'clock in the afternoon, we've got to look at this thing called H8, which is a
Right.
release that the Fed puts out on the commercial banks. And the market actually is going to be very sensitive to what we see there. With the past couple of weeks, which includes the banking crisis, what we've seen is there has been deposit outflows, but from 1 week to the next week, they seem to have slowed down. And meanwhile, most of the loan categories are still high up there. But none of that matters very much. What matters is what happens up ahead here. And I think the banks, they're still in business, and I think they're still going to be making loans. And I think you're right. There's going to be some issues in commercial real estate lending, either because the banks are uh, getting concerned about making loans in that area, because the developers just don't want to pay the interest rates that are being charged. So I think we are in a recession in real estate, but I think it's going to be a rolling recession. I don't think it's going to have economy-wide repercussions.
Yeah. Well, I think the market's kind of telling you that, right? I mean, look, when we had the banking crisis back during the great financial crisis, I mean, you had bourses off 40 to 60% depending on the indice. The fact that the market went up, like 1% or more over the course of last month says that in markets, collective wisdom of the market's pretty smart. That's looking to the future. That says to me that this just isn't the same kind of situation we had just over a decade ago.
Well, my new amazing insight into the market, which I gleaned by watching the market, is that every day that nothing blows up in the banking sector is a good day.
Yeah.
In other words, no news is good news, because back in the great financial crisis, we'd wake up every day and there'd be something new blowing up. Uh, that hasn't happened so far. I'm not giving anybody a guarantee that it won't happen, and will force us all to kind of rethink how things are evolving. But we've seen that the Fed, in terms of providing liquidity, does have a tremendous amount of power. We've seen that the Fed, in its ability to shore up confidence, has a lot of power. It's got a lot of critics, that's for sure. But all in all, we're still walking and talking.
Well, and on that same note, Ed, I'd say every time Jerome Powell gets on and talks, we all cringe. But it's our contention that at some point he'll probably ease up on raising rates, and at some point maybe lower rates. What are your thoughts on that?
Well, the yield curve, which is the relationship of the 10-year to the 2 year, uh, that relationship kind of sounded the alarm last summer when it inverted, so that the 2 year was higher than the 10 year, and that's been a pretty good predictor of recessions in the past. However, I think that the process is a little bit more complicated than that. Inverted yield curves, I think, show that investors perceive that if the Fed keeps raising short-term interest rates, something will break in the financial system. And as it inverts, it's a signal that investors are saying, you know what, I don't mind buying a 10 year at a lower yield than a 2 year, because, go for it. Keep raising the 2 year until you get a recession, then watch how quickly the 2 year will come down. And I'll be selling a bond that's actually got some capital gains instead of capital losses. So I think that's kind of, I think what the yield curve predicts really is financial crises that lead to credit crunches, economy-wide credit crunches, or even good borrowers can't find a lender. Uh, and then that causes a recession. That's what's been missing so far. But arguably, the banking crisis we have right now is that something that broke. The Question is, how severe will it be? Will it cause an economy-wide credit crunch? I don't think so, and therefore I don't think it's going to be an economy-wide recession.
Well, I know you don't think that, Ed, because I know the other day you made a bold projection and maybe just suggested that the S&P could actually finish the year at 4,600.
Yeah.
There's another strategist at a big firm who's looking for 3,100. I'm actually going to start a poll after our podcast today with our clients to see, betting on you or betting on the other guy. So, just so
Yeah.
you're aware.
I think pessimism sells, and it's easy to scare people, especially because we do have recollections of historical recollections of what happened during the Great Crash in 2930. We have kind of real-time experience. We lived through the great financial crisis, and then we lived through the great virus crisis. And in all these cases, panic set in. And it turned out that when panic was at its height, that turned out to be the buying opportunity. So I kind of I mean, I don't like what the pessimists are doing. They're scaring the living daylights out of people. But on the other hand, that also creates opportunities in the market.
Yeah, no, you're preaching to the choir. And why is that? I mean, it seems to me like, you do a lot of media. I happen to do a lot of television as well. And it just seems like the strategists always veer negative.
Yeah.
No matter what happens, whether the Fed's going to back off on interest rates or the Fed's going to keep raising interest rates, either way, you can spin it as a negative. Meanwhile, statistically, the market goes up something like 70% of the time if you look back in history. Why do you think that is, that we always have fear?
Well, I think it's tough to be a long-term investor because of all that noise that you get on a regular basis, and maybe you sort of have to tune it out. But that's just not going to happen. We have to stay informed, and I mean, one of these days we could have something that's really, really terrible. But I don't spend too much time about thinking about what could go wrong because there's so many smart people spending
They can do it for you. They do all the heavy lifting for you.
figuring all that out. And then, when the banking crisis hit, they all jumped up and down for joy. See, we told you so. It's the end of the world. And it just doesn't feel like it at this point. Uh, you know, uh, I mean, I'm very concerned about geopolitics and the cold, hot war between the United States and China. I'm very concerned about the proxy war between the United States and Russia. I mean, those are very significant risks. But on the other hand, I've observed over the years that geopolitical risks and tensions and crises also tend to be buying opportunities unless they're World War III, which I don't think this is where we're heading. So that's one of the many issues that the pessimists list as what could go wrong. Right now, they're really focusing on the banking crisis and how that could cause an economy-wide credit crunch and recession. And that's where where the difference lies between the few optimists that are out there talking about a higher market this year, and the pessimists who think we will retest the October 12th low and go below it. I think October 12th was the low for the equity market. Pessimism was as bad as it was, and the terrible days of the great financial crisis. And I really think that the bond yield, as I said back in late October, uh, peaked on October 24th. You know, for over a year now, we've been getting all upset about the interest rates going up. Well, they went up, and the world didn't come to an end. The U.S. didn't fall into a terrible recession. It's been a rolling recession, and it's been resilient. Labor market remains resilient, and life goes on.
Well, I liked your observation about the labor market. Blaming it on our generation. And I'm down in Naples, Ed, so I'm living it. I see what the retired baby boomers are doing. They're overwhelming the restaurants. There's not enough people to work in the restaurants. Overwhelming the healthcare system. Not enough people work in the healthcare system. So I thought that was a really good observation.
Yeah, the baby boomers is a generation that, on average, on a per household basis, has more wealth than any generation in the past as senior citizens. And a lot of them are still working, but maybe partly because of the pandemic, A lot of them had a couple of months there in the lockdowns to think about the meaning of life and decided it wasn't working anymore, and it was shopping and eating out at nice restaurants. And by the way, don't forget between the early bird specials to go to the doctor just to make sure that everything is ticking right. So they are putting a tremendous amount of demand for certain services that are very labor intensive, and that's why the labor market has been so strong. And they also have a tremendous amount of wealth. In other words, they can retire. They don't have to keep working, and they keep spending money. Uh, being a baby boomer myself, I do think, oh, let's say I could spend this on myself now, or I could leave it for the kids. Well, they never really cleaned up their room. They're kind of noisy. Well, let's see, what do I really want to do? Yeah, I think you do a little bit of both.
And I was gonna ask you about, you said that baby boomers have tremendous wealth. I was gonna ask you your advice about those baby boomers transferring some of that wealth to their children, but I sound like that's gonna be a non-starter for you.
Yeah.
No, I think that, as I said, I think they're going to do both. They've accumulated a tremendous amount of wealth. A lot of people own homes in the United States. They've got some mortgages, but they've got more home equity than ever before. Now, again, the pessimists are saying, don't count on that. We're going to have another crash in home prices. But there's a real shortage of inventory keeping prices up. So I think real estate values are going to hold up, and I think there is going to be a tremendous amount of money being transferred from the baby boomers to their children. I think the children are kind of counting on that, and that may be another reason why the economy is strong. Is younger folks maybe figure, I'm not going to have to save if I didn't annoy my parents and they leave me something.
I had dinner with a couple of boomers last night, retired, and we had that conversation. He said everybody they're going to dinner with saying the same thing. It's like if we don't spend it, they will. And we have this phenomenal wine collection. We might as well drink it.
Look, I think as a baby boomer, I feel guilty. I feel guilty that our generation has basically stolen from the kids. We've done that by having this huge debt.
Yep.
We should always mention debt because that's another thing that pessimists love to talk about. And I think they're right. I think it's a terrible thing that we've done. But the question is, why hasn't it had any real world consequences in the here and now? Why haven't we been made to pay for this sin, for this excess? And the answer is it's really a generational theft. We're leaving a lot of debt to the kids. On the other hand, we're leaving a lot of assets to the kids. So maybe that's that way of getting over our guilt of what we've done on the debt side. We said, well, all the more reason why we've got to take care of them on the asset side.
I think Chris and I are going to quit working today. We're inspired. Thanks, Ed. Bob, Bob's going to leave us his whole estate. But a question on that though. How does it end? The longer term, obviously, debt to GDP now is the stat you always hear is as high as World War II. I mean, it's worse than Europe at this point. How do you see that getting rectified or not rectified? Over the course of the next generation.
I've been doing this for over 40 years, and for that entire time, worries about the deficit and the debt have popped up on a regular basis, and it's we're living beyond our means. I've got a whole shelf of books back from the 80s when there was a lot of concerns about that, and then would you know it, under Bill Clinton, we finally actually ran a surplus for a short period of time there, but now we've thrown caution to the wind, and we're just spending like drunken sailors in terms relative to the revenue. So the deficit is a problem. But as I said, I'm very empirically oriented. I think it's always a mistake when you get kind of when you let your politics get in the way of your investing, when you let your conservative or liberal senses get in the way of investing. Investing is all about, in the stock market, is all about earnings, and it's all about valuation of those earnings. And we've seen the economy and the stock market doing remarkably well, even as the deficit of the debt continue to accumulate. So I don't really have an answer for how this all ends. It doesn't have to end badly because it hasn't ended badly so far. I mean, right now, we've got this potential utopia or dystopia with artificial intelligence. It could be like the the Roman times where we've got artificial intelligence robots doing all the heavy lifting, and we have a lot of spare time, and we all get a basic income. I mean, it sounds crazy, but on the other hand, you've got a lot of people now talking about we need to really control artificial intelligence because you're not going to believe all the good things and terrible things it can do.
Well, that's what I think. I think that when Ryan was talking about all these pessimists, I think that's the one thing they miss is that when the economy does turn down or when things do get, you get into some negative headwinds, they don't recognize that people that own businesses and big companies, they don't sit around and go, oh, everybody go home. Let's wait till things get better. Like anybody who's owns a business or works in a business, you work twice as hard. And, you make it happen. And for some reason, no one's ever able to see that.
Well,
Um,
there's another related point here that I just want to interject, and that is, when we all studied economics and read the Samuelson textbook, Economics 101, the basic message was that economics is all about the optimal allocation of scarce resources. I mean, that is such a depressing concept. I mean, that's what we do all day, is figure out how to optimally allocate scarce resources. And my response to that is no, 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 no. Economics is about using technology to solve problems and to increase
Yeah.
standard of living. So it
yeah.
creates more resources. And if there's a shortage of anything, we figure out
Yeah.
with technology how to replace it with something better, cheaper. And so I think technology right now has a real serious issue to solve for us, and that's labor shortages. Uh, we had the baby boom that created a flood of workers back in the 70s and 80s. But now we're kind of seeing that the baby boomers are retiring, and I guess we didn't have enough kids. And as a result, we're seeing labor shortages almost everywhere around the world, including China, by the way, except for India and Africa. So there's still some hope for young kids to keep things going. But this technology issue that needs to be the technology will solve is labor shortages, and it'll do that with technological innovations. Artificial intelligence may be part of that story, but we know robotics and automation are already a big part of it.
Yeah, no, it's a great point. And it's kind of like you look at it, people say, well, technology is going to replace people to the point where we're not going to have jobs. But I mean, if we have an unemployment rate that's as low as the 60s and technology has certainly advanced since the 1960s, clearly it doesn't displace workers at the end of the day. Like to your
Yeah.
point, it enhances productivity, which is a huge point. I also think that maybe we need a stronger immigration policy at some point because, and this is the thing that blows my mind at is like every strategist on Wall Street for the last year kept talking about how the labor market's going to fall off a cliff. And as if you look at demographics, it's like virtually impossible. With 2 million baby boomers or so retiring every year, it's like, how can it fall off a cliff? It's a huge shortage of, like your point, labor of people in this country that can work.
Yeah, and also there is an issue of work ethic and loyalty to companies. I mean, the labor market. I'm not saying it's subjectively. I'm saying objectively that's the case, and we have to learn to deal with that. I'm a baby boomer, and I work with millennials as some of our vendors, and have one or two working for us, and we all have to figure out how to work together. And I find that if some of them like to work late at night and it's hard to get them in the morning, I work around that and figure out how to interact with them. Uh, so there's a lot of learning by doing going on. And as Bob said, I think you said that, Bob, about the fact that the whole labor market has evolved in a way that really does it's different. It really is different this time.
It is, and I think that like every generation, we think ours is the greatest, and the next generation's lazy and doesn't work, not as smart, doesn't want to work as hard. But we have a lot of. I mean, our whole firm is made up of millennials, and they're smart, they're hardworking,
Absolutely.
and again, they got flexibility because they grew up with technology, so they're able to do things that maybe are non-traditional. But I think the economists discount that.
The only problem is that fertility rate is low. We're not having kids. People are living longer, and the percent of the labor force that's 16 years or older, in other words, old enough to work, that's singles is over 50%. It used to be like 30% a few decades ago. So we have a lot of singles out there, and that again, those are demographic factors that I try to factor in when I look at the economy and say, well, why is the labor market so strong? Why are we seeing record spending at restaurants? Why do we have a shortage of hospital employees? And a lot of this can be explained with demography. And again, you don't have to make a pro or con argument here. You're just trying to figure out how the economy works and how do you invest in it.
Well, speaking of artificial intelligence, Ed, are you still writing your newsletter, or is the AI doing it for you now?
We've been experimenting with it. It's fascinating. We do contribute to Twitter, and don't tell this to any of my followers on Twitter, but
Okay.
give the HAL 9000 or whatever we want to call it, whatever we want to call it. We give it an assignment to write 4 tweets based on this. I've actually the thing that's really exciting is I have to figure out if it's accurate, because there is the question of accuracy with artificial intelligence so far. But just for fun, I translated it. I had it translate my morning briefing into Chinese, Japanese, French, Spanish, and we have one lady who speaks Spanish and says it sounds right.
Wow.
Cool.
And it won't be long between we're all just carrying some sort of device, so you can go to any country in the world and just press a button of what country you're in and what language you want to speak, and you just talk into the thing and it'll translate it, and you'll have a conversation with other people. I mean, all the stuff that was sci-fi is here and now.
Well, Dad, you can take Saturday off now. You have ChatGTP write your market commentary.
I'm all for that.
It could be a situation where a lot of us don't have to do the initial writing that the artificial intelligence program does it, but we need to go over it and make sure that it's logical, because there's a lot of things that artificial intelligence just really can't do and probably won't be able to do.
Ed, unlike politics, what we say matters, and we have to make sure it's accurate. So we just can't spew some information and hope it's right.
Yeah.
Yeah. So in terms of financial markets, I know you're bullish as we are. What do you think is going to happen with the bond market here? We've been, like you said, you believe that the 10-year Treasury probably peaked at 430 last October. As we speak here, guys, we're closing in at 330 on the 10-year Treasury today. How much lower do you think that can go, Ed?
Well, it has been quite incredible, and shoulda, coulda. We all should have bought it 4.25%. But I remember the panic level at that level was intense, which again gets into the whole concept of long-term investing. Is you want to kind of stay with it. The problem is that's not really good advice when it comes to the bond market, because a lot of people bought bonds at near zero interest rates, including banks, by the way.
Yeah, unfortunately.
Yeah, that's what we're learning. Yeah.
Some really big losses, and they were able to continue to operate because those losses didn't count, because they're going to hold them to maturity. It did count with Silicon Valley Bank, because suddenly they had to sell some of those bonds and they had to sell them at a loss, and that kind of got the whole thing unnerved in terms of, well, what are these losses all about? So I don't mean to say that it's the only thing, buy low, sell high. So I mean that's still useful advice as well when we're thinking about long-term investing and around the trend. But I think I mean I've been in the camp that argue that a lot of the inflation has been pandemic related. So some of it, quite a bit of it, was transitory, particularly in goods. Now we're seeing in services we have an inflation problem. A lot of that is rents. There were a lot of landlords that couldn't collect rent or get an increase in rent during the pandemic, and so they had some catching up to do. I think we're already seeing in some of the kind of real-time indicators of rent inflation is in fact moderating. So it all depends on where inflation's going, and I think inflation peaked last summer. I think this year it's going to be 3 to 4% using the consumption deflator, which is a more accurate measure than the CPI. And I think next year we could be down to 2 to 3%. And then
Wow.
2025 we could be back down maybe to 2.5%. So I think the Fed is restrictive enough. I don't think they have to raise interest rates anymore, and I think the banking crisis demonstrates that, proves that. There's going to be an effect here on credit availability, which will slow the economy down. There will be the rolling recession will now roll into the commercial real estate area. But all in all, it should be a soft landing. But then productivity could really kick in. As you said, companies don't spend their entire day figuring out, okay, in the morning you figure out what costs went up the day before, and by the afternoon you figured out how to pass those costs through. It's not doing business. That's just managing a wage price spiral. I think a lot of companies are going to come to recognize, as they have already, that there's a labor shortage and that they've got to increase productivity. So
Yeah.
this is a good segue for the Roaring 2020s idea that, as bad as things have felt the past couple of years, this may end up as the Roaring 2020s, just the way the 1920s started out really depressing. And we had a great decade back then. Admittedly, it ended badly, but there was politics. With the Smoot-Hawley tariff, but that's a whole nother subject.
Yeah, I would say that was just a speed bump, Ed, in a term of long-term investing. That's all.
Yeah.
I know you're a very prolific writer. So for our podcast listeners, which one of your books would you recommend? Your latest one would be the best for them to read to get an idea of what's going on now?
If they're very liberal, I would like them to read my book on profits. It's called In Praise of Profits. I wrote it for liberals just to sort of provide, I think, a fairly data supportive view on why profits matter a lot and why profits create prosperity. But at the same time, I acknowledge the fact that free market capitalism, if it's so great, why aren't we all buying into it? I think that's because of crony capitalism. So I try to be somewhat even-handed, but it is definitely a call for supporting entrepreneurial capitalism, not crony capitalism, but entrepreneurial capitalism, where we actually care about our customers and we try to do the best we can for our customers every day. You want to call that selfishness? I don't call it selfishness. Like I call it insecurity. If I don't please my customers, I'll be out of business. So I have to think about what they need. And that's kind of the point of the book. A lot of people who are relatively young and getting into this business, there's so much that happened just in the past 40 years that are relevant today. So predicting the markets, which is the subtitle, a professional autobiography, I think is worth your while because it is a professional autobiography. I went back and said, okay, what happened during my career so far, the first 40 years? I'm working on the next 40 years. But what happened during the past 40 years? How did markets respond to all these things? What did I learn? What did I get wrong? And I think you'll find that useful. And then I wrote a couple of books on Fed watching, which I think is also useful because the Fed is in our face all the time. I call it the Federal Open Mouth Committee. Constantly yapping away, and we have no choice but to cover them. And I don't like to criticize them because they're sort of my bread and butter. I mean, they always give us something to comment on and to opine.
Yeah, I like that. I mean, it just seems like it's getting worse and worse with all the Fed officials every week talking. Well, Ed, to wrap things up, and I love the optimistic tone. It fits right in with our beliefs. So we're going to switch gears on you. This is a question we ask all our guests. If you could pick one album during your life that you heard that changed your view of the world, what is it and why?
Oh, it's just one song. We didn't start the fire. Billy Joel.
Billy Joel. All right.
That's definitely a fun song, and makes the point that a lot of good things and bad things happened during the prime of the baby boomers. Some of it we caused, and some of it we didn't cause, and we all live in historical times. Eventually, somebody writes a history about what it was like to live in our times, and I think everybody actually should write a book because it'll give you some perspective on how everything sort of affected you and what made you the way you are. But So that would be my song. I was a little surprised to see you ask me about songs because I usually do
Yes.
in the mornings, and just finished seeing The Godfather of Harlem, which is really excellent. It's fascinating insight into the 1960s in America.
I enjoyed your review of Cocaine Bear as well. A lot of insight there.
Was saying to me, what were you thinking of? Why would you possibly go see that movie?
It just looks so
Really,
funny. I,
it would be really funny, but it was, but it was awfully grisly too. So grizzly bear
I wanted to see you relate that one to the economy, Ed. Then you
can't
really.
do anything within reason.
Well, thank you very much, Dr. Ed. That was a phenomenal conversation, just great insights, and really fits in with our philosophy. It's better to be an optimist than a pessimist when it comes to investing. Not a lot of rich pessimists when it comes to being an investor long term.
Yeah, well, a lot of too much pessimism. I agree with that. But we want to be balanced. We want to know what the pessimists are saying, and then make sure that we do. And actually, that's a good way to start to say, okay, what could go right instead of what could go wrong, because everybody knows what could go wrong.
Hey, hope you're enjoying episode 117, Payne Points of Wealth. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially, literally at any stage of your journey. Bob, Chris, and I now have a collective 75 years helping individuals just like you with your planning and investing. This is literally what we do every single day. But if you want a more hands-on approach, you want to get a full review of what you're doing with your financial independence plan, if you saved over $1 million, Chris, Bob, and I will run through our total financial master plan, and we'll do that at no cost. There's no other firm out there that will do this work up front. We literally build you your own personalized financial portal. We'll hone in on every financial issue you need to address today, whether it's an income plan for retirement, how to take Social Security, how to draw from your portfolio, factor in inflation. We're going to do a deep dive of all your investments. We'll go through those annuities, insurance products, mutual funds, brokerage products, show you where all the hidden costs are, show you how to reduce costs on your portfolio and optimize your portfolio for taxes. It's not what you make, it's what you take. We're going to give you our full tax playbook, and we'll look at diversification. We'll look at how much risk you're taking. Did you get hit hard in the last year as markets have been all over the place, or have you been sitting with way too much money in cash? Paralysis by analysis, trying to figure out what to do with your money. Well, we're going to put together a full investment game plan, show you how to grow your wealth, but most importantly, protect it over the rest of your life. Simply go to www.paynecm.com/financial plan to see if you qualify for a free financial review. All right, it's the hidden facts of finance, random financial facts that may surprise you or even shock you. All right, Bob, after $6.3 trillion spent on renewable energy and another $3.3 trillion spent on electricity networks since 2005, global energy use is still 80% reliant on fossil fuels. From a low of 70% in Europe to 86% in emerging markets ex-China, the global measure has declined by just 5% since 2005, even with all that investment.
Well, first of all, Rye, electric vehicles are very expensive, and we're from Philadelphia, and they have a lot of row homes in Philadelphia: North Philly, South Philly, Southwest Philadelphia, and every other city in the country is the same way. So if everybody's going to have an electric vehicle, how are you going to recharge them?
Well, they do have charging stations, so I guess that'll be like the future at some point.
Were you gonna put it in the middle? Are you gonna put it in the middle of the street? I mean, when's the last time you've been to West Philadelphia? There are no garages. So where do you put the charging station?
Well, a very popular
Sure.
pastime here in Philadelphia is stealing electricity off the pole. So, maybe something like that.
All right.
Yeah. Or do what I did in college where we just ran all of our electrical devices through the basement. So, just a thought there.
My understanding is Pico still have Hitman after Ryan.
It's like Dr. Yardeni said, right? We're at innovation, right? Technology, innovation, that's going to be the answer. Somewhere down the line, they'll figure it out.
Yeah, no, 100%.
But I'll tell you what, I wouldn't give up on gas vehicles in the very near future.
All right, Bob, we heard it here first.
Yes.
Chris, assets continue to flow into institutional government money funds, about $200 billion over the course of the last couple of weeks. The asset class is at an all-time record high at over $5.5 trillion. Angst around inflation, recession, and rate hikes has proven too much to the bear. So people have retreated from stocks to cash. That's a lot of money sitting in cash right now.
Well, you know what? This is an age-old problem. We're getting great yields on money markets right now, but it's so short-sighted because what happens if interest rates start to come down? Now you've got all this money sitting in cash at low rates. And chances are the market will probably have taken off at that point. So you missed out on the opportunity.
Well, it's literally like a big powder keg, too, because God forbid, just like talking to Dr. Ed today, we have some more optimism with earnings, the economy. That's a lot of money that can flow back into the market. And you want to be there before all that cash gets back in. Just saying.
Yeah, the only people that are really going to benefit from this are the banks, because they're charging fees on these money markets and they're making big profits. The only person that loses is the investor.
Yeah, my client called his bank the other day and said, my buddy Bob's giving me 5% on cash. You're giving me 2%. It's like, you're charging me hedge fund fees to manage my cash without hedge fund returns. Could you explain this, please?
Yeah, well, maybe the banks will stay in business.
Hey, they figured out how to make a profit and 0% interest rates. I'm not worried about the banks, guys.
Yeah, I think the banks are here to stay. Just a wild guess.
Yes.
Well, another great show. I hope you enjoyed episode 117, Payne Points of Wealth. If you love our podcast, give us that 5-star rating on iTunes. Leave us some comments. If you're watching this on YouTube right now, you can like this episode. You can subscribe to our channel. Click that notification bell to be updated every week of all our new content. If it's on Spotify, you can also subscribe to our channel. Your support gives us the ability to continue to do this podcast. As always, stay loose and keep an open mind.